I do like to start off the week with a kind of a summary of what I saw happening this week in the market. I have a chart here of the S&P 500 year to date. And so you can see, obviously, we've had a downturn. We hit a low here in middle of June. We've had a pretty nice run up since then, actually. That blue line that you see here is the 200-day moving average. So to me, that's fairly important. Two pieces there. Number one is it's going down, and the price is under the 200-day moving average. To me, that's the definition of a down market. So the major trend is down, and this uptrend that we're having is a bounce on a down market, or possibly a new uptrend that starts and turns the major trend to up. And so I've got some things that I'll show you. That's what we look for before we decide that this trend has reversed, because we do different things in different markets. We have one investment concept that works in a trending upward market, another one that's going in a sideways market, and one that works in a down market. So those are our three things. Right now we're using our down market methodology until we start to see this entire thing change. You can have these very large run-ups like we've seen here. As a matter of fact, if you look on the chart there back in March, we had another big run-up also. You can have those in these rolling down markets like we had in 2000 and 2008. So you have to be very careful to get sucked in there and think it's all over. And I'll show you some of the things that we look at. But this week was very interesting because if you look back to March, when we had that big run-up, and if you look right after March, it basically went straight down. And what happened then was that the Federal Reserve started coming out and doing all of these interviews in the first week of April, talking about how aggressive they were still going to have to be to fight inflation. Because you got to understand that the Federal Reserve really has trouble with a stock market that's doing very well in a high inflationary environment, because it just makes money more available. It increases the likelihood that you'll have more inflation. It makes their job harder. So they start to come out and make, aggressive statements and hope to scare the market back down. And that's what they did this week, just like they did back in the first week of April. But the difference was the market didn't drop. It stayed up as far as that goes. So that was really important, I think, as far as that goes. And then today we had the jobs report came out. And this is one of the great ironies right now. The expected number of new jobs was 258,000, and we ended up with 528,000 new jobs. So normally that's good. Market would respond positively to that. But when you have inflation running at currently 9.1%, that's a problem, especially because the average wage increased by 5.2% over the last 12 months, and 0.5% to 0.5% over the last month. And what happens when wages are going up and when lots of jobs are being created, the market gets very hot in the labor market, and all of a sudden, companies are having to pay more for their employees. They pass that along sometimes as a higher price to the consumer, which again makes things more expensive for the employees, so they want more money, and that's this wage inflation cycle that they talk about. And so that was a concern today. But if you look very closely at the last little bar here, it actually didn't fall out of this range today. It's been kind of a muted response to what could have been a bad report to the market as total, because now the Federal Reserve is looking at probably having to raise rates at a faster rate. So the expectation was next meeting September, 0.5%. Now all of a sudden the expectation is 0.75% again, which would be 3 of those in a row. And the danger, of course, to the market as a whole with these rate increases is that they are delayed in their impact. So they raised rates in September. You might not see the true impact of that until March of next year, 6 months later. And so that's where you get into the risk zone, because the Federal Reserve keeps raising rates based on all these things that are happening. And eventually things do start to slow down, but of course the impact continues forward, and all of a sudden you're in a deeper recession than expected, and the Federal Reserve has to run and make an adjustment and start to lower rates again. And so that's kind of what the market has been expecting, is that the Fed would be lowering rates by February. I think this job report probably pushes that out some as far as that goes. So that's kind of what's going on. But what I'd like to cover now is just some kind of the technical areas that I'm looking at. So technical analysis is essentially the study of charts, volume, resistance, support levels, moving averages, all of these different types of things. And I'll just show you kind of some of the things we're looking at because I think it's very interesting where we're at right now and kind of the importance of that. So first of all, I drew a line in here that is both a support and a resistance line. If you look back to earlier in the year, we bounced off of that line and actually had that big run up in March. So that was support. It jumped off of that. Eventually we broke through that, and then you can see here in kind of June where we hit into it. We ran into it for 8 days in a row before we fell. And now we've done it again. This is the 6th day in a row. We're running into that same resistance. We haven't been able to break through it. It is quite important, at least for the total recovery of the market, to be able to break through this. And so we'll see what happens. On the other hand, if you look at kind of the support side right now, there's a lot of support just below where we are. So we're in this little channel. And so you can see we're bouncing around just like we did back in, early June. And one of the things I always like to tell people here is that you have to be really careful. Yes, the market has had this big run up, but right now the market is just trading inside this little range. So if it goes up 1% or down 1% and it doesn't move out of this range, that's not useful information. I always look for information from the market. If it breaks above or below, that'll be useful information. If it's just bouncing around, like even today, yeah, the jobs report came out, but we're still in that range. So I'm still not getting the info that I need to be able to decide what I might be able to do next. So for example, if we break below that range, we're going to fall most likely into this zone right here. This is the next support level as far as that goes. This little area, this light yellow area that I put in there. That's about 5% below where we are now. And if we fall below that support, we're going to set a new low. We're going to go below where we went, most likely, because there's not a lot of support below that. We're most likely going to go back down to a low below where we were in June, right? So that's information. We're still inside that little zone, as I pointed out here. And so until we break below that, again, I'm not sure what's going to happen. You have to be patient here. So it goes below, we got that zone. If it goes above, here's the zone above. And so this is kind of, again, about 5% above where we are. Could have a nice run if we break through. And now we're starting to really start to check the boxes for turning this into a major uptrend instead of just a minor uptrend, right? Because the major is still down right now, below the 200-day moving average. 200-day moving average is going down. But the checks, you make check boxes as you start to recover, just like we did in 2020. And so one of the things is to get through this first resistance level and then get into that next resistance zone, right? So then if we can get into that zone and break out of that zone, there's quite a few things happening all at once. I just drew a trend line there across the top. So go back to January. That was the all-time high for the S&P 500. Cross the top of what happened at the end of March. And if you look, we've got that yellow zone. We got the 200-day moving average, which can be resistance also and support if we can get through it. And we have this trend line. If you move forward a couple weeks, those are probably all going to converge at roughly the same spot. Probably about 4,300, 4,400 zone for the S&P 500. And so what's happening there is that's a huge issue. If we can get into that and through that, it's likely that we're actually going to start to go towards a new all-time high sometime in the second half of this year. But we've got a long ways to go. And again, as long as we're in this trend right now of just kind of going sideways, you can't really make an assumption that we're going to go crazy to the upside. And you can't make an assumption that we're going to fall apart either. So our status right now is we have, about 20% of our stock allocation in T-bills right now. And the rest is exposed to the market, which has worked out well on this upside. Could have made more if we had all of it in. But because of what's happening with all the different signals for possible recession, the Federal Reserve's aggressiveness and all those things, we're still maintaining a conservative standpoint. If we break above some of these areas, we'll start to reduce our T-bill exposure. If we fall back below, we might even increase it. We'll see what happens, depends on where it goes. So that's what's going on right now, just kind of on a broad technical basis. There's lots of different things we look at, but I just wanted to share kind of how this works, especially these support and resistance levels, which can be very, very important, in the short term especially. So that's what's going on. Look forward to being able to talk to you again next week and discuss, what's happening with the market.